PPP answers, questions and answers. And as you're probably going to hear today, we're pretty much predicting there's going to be more changes in the works. But today's session is going to be on PPP the forgiveness, and I'm going to hopefully talk about some of the shape of the recovery as well. I'm a CPA. I'm also an attorney, a CFP and a CFA. Worked at Walsh College and was a graduate professor there. And right now I'm the Chief Growth Officer for Sequoia Financial Group Business Plan. So, Jamie, I'm going to flip it back to you and let you get started.
All right, sounds good. Thanks, Leon. So again, just some quick housekeeping. Let's make sure everybody's on mute as you're coming in, so that way we don't get the background noises. If you guys have questions, we're asking that you do the questions through chat. You can do some that are, there's already some that are already in there, and we'll try to get to as many of them as we can as we go through this. And Leon or I will be paying attention to that and kind of throwing the questions out as we feel that they're appropriate.
Jamie, I'll get the questions.
Okay, thanks. So just the normal disclaimer, don't blame the messengers on this. What we're finding is these messages, everything's changing on a daily basis, and what we know today could very well change tomorrow. In fact, it could change by 3 o'clock today or so with the Senate meeting, and this is still an evolving situation. And I think when the PPP first came out, I don't think they anticipated the COVID-19 to last as long as it has. And so I think that they're looking back a little bit with the 2020 vision now. And so things are still expected to change. So we're going to get started with just some simple updates, and I'm going to let Leanne go through the updates that have occurred to this point.
Yeah. First of all, there's been several things come out, multiple questions by Treasury, multiple things out there. One of the things that came out was an up and a down was the certification of the safe harbor. All borrowers were required to certify in good faith that they needed the loan, and that wasn't really in the beginning. The beginning was you needed to pay payroll, and there was economic uncertainty. Well, virtually everybody had economic uncertainty under this COVID crisis. I mean, even if you made masks or protective equipment, you had that. They have subsequently come up to the fact that loans under $2 million are deemed to have made the certification in good faith. Above $2 million are going to be audited. We're seeing a lot of flack going from publicly traded companies. I saw that a good portion of the first round of PPP went to publicly traded companies. They have since remedied that, and now it's being, a lot of companies are turning their loans back in. There was an interim final rule on loan increases as well that allowed partnerships to ask for an increase in the loan if it didn't include the partner's income, because they didn't bother to tell us this. And then finally, they gave us the loan application form. Jamie and I sighed a sigh of relief and thought this was it. Oh boy, it's done. No, there's still open holes in this, and Jamie and I have had conversations along with our fellow CPAs about what's going on with it. But Jamie has done a remarkable job of going through the application and really taking it through. It's an 11-page application, could be simpler, but it certainly did clarify a lot of things. And Jamie, you and I have been back and forth on this, only a couple of gray areas now. Instead of the whole thing being gray, there's some black, some white, and a little bit of gray. So why don't you take us through the app, please? Sure.
So there's 4 forms. 2 of them only need to be required. 1 worksheet, and then there's a demographic with everything else being explanations and some various other calculations scattered throughout the process. And so what I've done in this is I've worked this presentation not based on following the form, but based upon the major concepts. And so they'll be spread out throughout the form, through the application form, but the concepts are there. So let's just do a little bit of a refresher of what is forgiveness. In the Treasury has defined 3 possibles, and it's the lesser of the 3 following, which is, we always knew that it was always going to be based upon your adjusted actual costs, which is your payroll, non-payroll, adjusted for either full-time equivalents or salary reduction. That was always part of the law, and that still maintains true. We'll get into those calculations as we go through this. We can never, ever exceed your PPP loan amount, so that is going to be capped at that point as well. Treasury then all of a sudden decided to take it amongst themselves and throw out this 25-75% rule, saying that because of the congressional intent, we're only going to allow for 25% of the borrowing to be forgiven if it's used for non-payroll costs. The other 70%. And so they always capped it at 25% of the non-payroll costs. Well, what they did in the final application is they basically said, we're going to cap the loan forgiveness at an imputed of 75% of the payroll cost, meaning that the payroll costs are going to have to, no matter what, equal 75%. So, for example, you take your total payroll cost divided by 0.75, that gives you the amount eligible for forgiveness. And so you take the lesser of the three. In my example here, I've got a $50,000 in payroll cost. The maximum forgiveness would be $66,667. Now imagine if you had borrowed $80,000, that 75% is $60,000. You're short by $10,000, right? Well, somebody says my screen's not sharing. Is everybody seeing my screen?
I can see your screen.
I got your screen.
All right. So and so you get an $80,000, and so 75% of that is $60,000. That means that the other $20,000 could have been used for non-payroll costs. Well, under this calculation, when you all of a sudden this lowers the amount eligible for the non-payroll costs as well. So as a practical point, we need to make sure that we're really truly trying to maximize our payroll costs to that 75% at least of the amount that we borrowed, or we're going to see a reduction not only in the forgiveness associated with the payroll costs, but in the amount of the non-payroll costs as well. So this was a new little big twist that Treasury, that I did not see Treasury coming from Treasury when they put in the final rules or final application, if I say. So they've done a couple things here, and we all knew that this 8 weeks existed, or 56 days. And they've come out with rules that said, well, there's always confusion of when does that start. They've said that it starts on the first day of when the loans have been dispersed. So that starts the clock ticking. There has always been a argument, and the American Institute of CPAs put this argument out there as well, that, hey, let's keep it simple for those employers that have maybe biweekly or more frequent payroll schedules. So let's, instead of having to do special and odd payroll runs and all of that, why don't we make the forgiveness coincide with the payroll periods? So Treasury took that under consideration, and it looks like in the final rules, they did adopt that potential rule, and they're calling this the alternative payroll covered period, which I've just dubbed APCP, and you're going to see that through the slides, just because it's too long to put in alternative payroll covered period. So this begins on the first day of their first pay period following their PPP distribution date. So for example, if you receive the funds on a Monday, the 20th, and your next payroll period begins on Sunday, the 26th, your alternative payroll period is the 4/26 to 6/20, not starting at 4/20. Okay, so this is actually as good, because we had always said prior to this, you're going to have to do special payroll runs and things of that nature to make sure that we get the paid and incurred covered within the loan period. And can I ask, is there somebody that's on here that hasn't been muted? I'm getting a lot of feedback from them. I don't know who it is. Is it anybody? Are we getting?
I'm not hearing the feedback, and I'm so seeing that everyone's muted.
All right, so I don't know what it was then.
Same, Jamie. I'm not seeing it either. So
I think the moderator can mute everybody. I think they have that control.
Yeah.
Yes.
So, all right. So,
Jamie,
yeah.
One point. We've had quite a few questions on that, so I hope that this APCP covers it. We've had at least 3 questions on the APCP, and I think that was a positive thing. It got us a special payroll rule. And are you going to cover paid or incurred? Are you going to cover that?
Yeah, we're going to cover it when we get into the payroll costs. We'll get into paid and incurred when we get into that. In fact, I believe that's the next slide. When we get into eligible payroll costs, one of the things that they did say is that if you're going to use the APCP, or the alternative payroll covered period, you have to use that through your entire payroll for all of your calculations relative to when they say covered period or alternative covered period. Now, this only is going to apply to payroll only. The covered period is still going to be applied to your non-payroll costs and some other other calculations. So as you're going through the application and the forgiveness calculation, you're going to have to be careful when they use the word covered or alternative payroll period. So keep that in mind, that it's even though you may pick the alternative, that's going to be typically for the payroll calculations only. So that's important to know. Eligible payroll costs. For the most part, payroll costs have not changed from the definition used in the application for the loan. It is still the same definition of what is payroll costs. They've tweaked it a little bit, but it's still the same definition. In fact, in the instructions, they refer back to those definitions relative to that. The paid and incurred is either during the 8 weeks of either your covered period or your alternative payroll covered period. They will consider anything paid to be when the checks are distributed or when you've originated the ACH through direct deposit. The payroll is incurred or considered incurred on the day that it was earned. So this is you're starting your paydays, okay? However, the Treasury did throw in a little bit of a bonus that, and this was not in the rules anywhere, but said the payroll cost incurred but not paid during the last day of the CP or the APCP are eligible for forgiveness if paid on or before the next regular payroll date. So they're giving us some guidance and and we're going to see where they've done this in other places as well, where they've said, we understand that everything's not going to match up, and we're not going to make you go through and do anything special because of that. As long as you pay it before the next payroll period, we're going to count that as being considered paid. So they're giving us a little bit of expansion on that paid if you fall into the, depending on what method. So you could still use the covered method, and you could have a payroll that was incurred, but you may not, and the payroll end date ended well during the covered period, but you didn't pay it till 3 days later, which is typical. They're going to allow that to come back and be part of that, which I thought was very lenient of Treasury, and was glad to see that they've really taken some steps to allow to remove some of the administrative heartache that I was expecting was going to be there. I was advising a lot of my clients early on to be prepared for a special payroll run on that, if you will, that 6th day of that 7th week. Okay. I know I've seen a couple questions, or I saw a question in email and I saw it on the chat here. What about monthly payroll? From what I can tell, the alternative payroll does not cover monthly payrolls. It's biweekly or more frequently. So I think what you're going to have, but what I do think that you would have is you would be able to count the cost in a monthly payroll. You'd be able to count the cost earned, or the pay earned, up until the end of your covered period or whatever period you're using. But if you don't pay it till the next month, you would still fall within the Treasury's guidance. So
I think you're right, Jamie. I think that, yeah. I agree with you. Yeah.
So I think that, so hopefully that answers your question. You can still keep your monthly payroll, and it's just going to be based on earned, but if you pay it, as long as you pay it, you should be okay. If you want to be super safe, make a special payroll run, but that's up to you. They gave us guidance on the $100,000. Bi-monthly is less frequent than bi-weekly, so I think bi-monthly would fall in the same thing as monthly. I saw that from somebody else as well. So the same concept. You're not going to be able to choose the alternative payroll method. You'll be able to use the covered period method, but you still would be able to cut off as of the end of the covered period and just pay on the next normal, the 15th or the 30th, if that's what you're doing. So for example, in this case, let's say your forgiveness period or your covered period ended on the 20th and you don't pay till the 1st, the payroll incurred through the 20th would count, even though it's not paid until the end of the month, if that makes sense. One of the things that they did for us on this, which I thought was great, was everybody's asking that, what about the $100,000? Can we pay bonuses? Can we do this? They basically said, we're going to look at the $100,000 annualization over the 8-week period. So essentially they've said, you can't, the only wages that are going to be eligible for forgiveness is going to be $15,385 per employee. End of story. It doesn't say of when it needs to be paid. It just says that's the max we're going to do. So it allows for a little bit better planning as we get closer to the end of our 8-week period, whatever method we choose, to make some adjustments if we don't think we're quite there relative to payroll. We can give a little bit of a bonus or things. The only, as we'll see later, the only place that you cannot play around with this is for owners. And we'll get into that in a couple slides down the road. And again, like I said, the non-cash still includes payments for non-cash payroll costs include health insurance, retirement, and unemployment. There's some questions on whether it should be HSAs and things. I would throw it in there because HSAs are follow the insurance, but I don't think that you're going to be able to get any other type of insurances that are there. So, and then the unemployment is going to be unemployment that's paid. So that might be a little bit of an issue there. And then retirement, we've had some questions on this. The way I read it, it's going to be retirement based upon the retirement that would have been calculated and paid on the payroll earned during the 8-week period. Leon, is that how you interpret that as well?
Yeah, same thing. So if you got an employer match on the 401k, it would be the amount that you would have matched during that time period.
Right. And also I think that if you've got a discretionary contribution, you can recalculate that discretionary on that 8-week payroll and then make a payment and it would still be covered. But I think that if you can't prorate that, it's still got to be paid within the covered period.
Jamie, 2 questions popped up. Supplemental insurance included in health insurance. I'm presuming what Julie is asking is, does this mean like life insurance and stuff like that? I think you and I agree it's health insurance.
Yeah.
But if it's buried in the health insurance, you and I have both said to clients, go ahead and put it in and see what happens.
Yep.
Raj asked a good question. S Corp owner didn't run payroll from January to April. Can we run payroll during this period? I think what I'm saying is the answer would be yes, right? If you didn't run payroll during the time period, you can run it now. It actually probably bodes well for forgiveness, wouldn't it?
Yeah. Yeah. And then he's got an interesting question about S Corp with multiple entities. I would have to look at the affiliation rules, but I think that should be okay, especially if they allowed it to be borrowed on that.
Right.
So I think.
Yeah, go ahead. And Jeff was asking, does payroll costs include FICA paid by the employer? The answer I think is no. No, that's been clear. That's been clearly defined, and even in the calculation, because that was a question that came in the application for the PPP, and that's been clearly defined and does not count. Lynn asks the question: are you obliged to repay any extra loan amount that hasn't been forgiven prior to the end of the loan? The answer is yeah. You got to pay it, but you could pay it up to the 2-year period of the PPP loan. Is that correct?
Right. Yep.
And food. Mary's question is: food covered federal unemployment tax? No.
Nope. The only taxes are state and local that are based upon compensation. So it's not withholding. It's and for Michigan, it's going to come down to Michigan unemployment. Some other states like California and stuff have some other taxes that are predicated on gross wages. Those would be thrown in, but for Michigan employers, it's really going to be your UIA.
Right. So SUDA is good. MESC is good, but food is not. Right.
Exactly. Yep.
Okay. Sorry. Go ahead. You're doing great.
So non-payroll costs, this was interesting because we've always said that payroll costs were going to be based upon paid and incurred during the period. In the instructions, though, they got rid of the word incurred and said paid during the covered period. So this is a little bit of a disagreement from some of the other CPAs that I've talked to, and we're trying to. So I want to caution people to proceed with this with caution, because does this mean that if I didn't pay rent early on and all of a sudden I catch up with it during this period, would this be covered? And I'm gonna caution and say that it could be, but because of the instructions, because it doesn't say it had to be incurred during the covered period, it just has to be paid during the covered period. Okay, so it's possible. And then they go further and say the definition of the incurred is incurred during the covered period and paid on or before the next regular billing date. And this is a treasury bonus even after the covered period. So this is good for those that maybe have incurred a cell phone bill that is ended on the last day, and you don't pay it till, as long as you pay it before the next billing date, it's going to be able to be brought back into your forgiveness calculation. So again, that was, they've given us a little bit of flexibility on this paid and incurred. I would be careful. Yeah.
One question back to payroll for a second.
Sure.
What if I got a commissioned salesperson and they earned a commission in, prior to the period, but I pay it during the PPP period. As long as I don't go over the 100 grand, I'm probably okay, right?
I think you're okay. I think that yeah, I mean, that's an interesting question, because you've got the issue that the payroll, they say it still has to be incurred, and it's incurred when earned.
Yeah.
So I think that there may be an argument there that says that because it was incurred prior to the beginning of the PPP, it's not eligible for, regardless of when it's paid, because of the fact that it was incurred prior to.
Now, strangely enough, they could pay that personal retention bonus.
Or they could up there, as long as they're not an owner, they could always pay them a higher base on their commission and take it away from future potential commissions.
Yeah.
So
there's a way to skin the cat, but I don't think you could do it directly with the commission.
Right. I think that you'd have to look at other creative ways to get around it.
And somebody else asked go ahead.
No, I said barring any other treasury, any other treasury rules that they come out with.
And somebody said, if you hired more people in May and June months on forgiveness, well, it just helps you. You and I figured out it's almost impossible to get a full forgiveness no matter what you did. But if you hire more people, that's just a benefit. That's a bonus. That's a bonus.
Yes. Yes.
And then there was another great one. If I have a 100 grand loan, I use 80 grand for payroll and 10 grand for utility or rent. Does the remaining 10 grand turn into the loan? Well, if you can't come up with enough extra expenses, but remember, there's other things in that utility. Utility includes transportation, right, Jamie? So you should be able to try to get that in there. It's electricity, gas, water, transportation, and probably most importantly, telephone and internet access as well. So I would say, if you got 80 grand for payroll, trying to come up with the non-payroll stuff shouldn't be terrible, but and the answer to the question is, if you didn't use it, you got to borrow, you did borrow money.
And that, that scenario is going to play out a lot depending on because remember, we borrowed on 2.5 times your monthly costs, and we're required to pay out just two times in 2 months worth of payroll. So that extra 0.5 is for all these other costs. And if you've got low overhead, there's a chance that you're going to have to pay it back because you didn't use it for what it was intended for. So keep it, or you keep a loan and you use it for other things.
And it's 1%. What's wrong with 1%?
Yep.
And no payments for 6 months. It's not the worst thing in the world.
Yep. So I see a lot of questions relative to FTEs and stuff. Trust me, we're going to get there. So just let everybody know that we're going to get to the FTEs and the number of employees and so forth. I'm just kind of working through some of the overall, and then we'll get into some of the details. Again, Leon, to your point that you just mentioned, that we've got the interest on business and mortgage interest, we've got business rent on leases, and then we've got utilities, electric, gas, water, transportation, telephone, and internet. Transportation is an interesting one. What is the definition of transportation? And based upon what I saw in the definition of the self-employed, they used it as an example, and it's really going to be fuel used for business vehicles. And the question I have, and there's no clarification for this, what if you're a landscaper and you put fuel in your mowers, or you run you've got tractors and stuff that you use? I think that would count. Personally, I would, because it's still a fuel and it's still part of a utility to use things. So I would probably do it. Again, keep in mind, banks are the final decider on all of this. I'm taking the philosophy, I'm going to throw in as much stuff in here as I can, and I would rather been told no than realize I could have gone for something and not get it there.
What about a car allowance? What do you think of that?
Car allowance, I don't think, because it's not specifically used for fuel, I don't think it would count. It would not count.
That's the way I read it too. I read that too. I did. I ran into somebody at a trucking company, and they were asking about fuel, and I said, basically your answer, I said, they defined it as fuel, and they did not say fuel that's not cost of goods sold. They just said fuel. So.
But I mean, and keep in mind that this is still, I really think that this, getting nitpicky on some of this stuff, because if you've got a transportation company, chances are they've got high rent anyways. And so they're going to get to that 25% in other forms. So I think that trying to nitpick on all of this stuff is going to be either very minor in dollar amount, where the banks are just not going to bother, or you're going to get there somewhere else and it's going to be immaterial in the whole equation.
I'm going to try to keep our questions going because otherwise I'm going to have 10,000 of them and they're not going to get anywhere.
Sure.
You and I and the rest of our CPA colleagues agree that retention bonuses are part of compensation as long as it doesn't go over 100 grand, right?
Yep.
That's clear cut to everybody. Yeah.
Yep. It's compensation is going to be cash paid. So I know it is in my thing. So this is an interesting thing that they did is owner compensation. And this is one that I've got a little bit of a bugaboo with Treasury on, but what they did is they have pulled out owner compensation, and they define owner compensation as owner employees, self-employed individuals, or general partners. The owner employees are the one that bothers me because that is your S Corp shareholders and C Corp shareholders that have ownership in the company and still are taking payroll. So they're now thrown into this owner compensation where the regulations that they were drawing this on actually specifically never mentioned them and was talking more about the self-employed. However, the Treasury decided that they're going to lump all of us together in this. And so what they basically said is, we're going to pull out anybody that's considered owner compensation, and we're going to pull it out of all of the other payroll calculations. And we're going to say your compensation is now separately stated on the application. And it's not part of the FTE calculation or the reduction in salary calculations anymore. It stands on its own. The other part that they threw in here is the cash limitation, or the cash compensation, is going to be limited to the 15,385, which is that 8-week equivalent. I have no problem with that. That's consistent. But they threw in this, or the 8-week equivalent of their 2019 compensation. So there is going to be no room to give owners any additional bonuses above and beyond what they've received for 2019 compensation. So it also means that if you had an owner that was not paid in 2019, you're not going to be able to use his or her wages for your calculation for forgiveness on the application. I think that applying this to S Corps and C Corps was a mistake on Treasury, but there's nothing we can do about it at this point. It's kind of frustrating to me, but it is what it is. And so I want everybody to be aware of that there's limitations. Now this follows the C Corp, or not the C Corp, the Schedule Cs. This follows exactly, because they came out with guidance and said, Schedule Cs, we're going to make it very easy for you. We're going to take your line 31 of your Schedule C, we're going to divide it by 12, multiply it by 2.5, that's what you get to borrow on, and your forgiveness is going to be that same number divided by 52, multiply it by 8, that's your forgiveness, plus any other costs that you may have, other non-payroll costs or other payroll for employees. They took that same concept and said, we're going to apply it across to all owners. And I don't agree, but it is what it is. And I was originally going to say, well, I'm just going to skip this because the rule doesn't apply. However, in the application, you have to go through a certification process. And right here, the fourth certification down is, did you dollar amount that was requested for forgiveness does not exceed 8 weeks of worth of 2019 compensation for any owner, employee, self-employed individual, capped at the 15,385. So if you try to get around this, there's a certification that you could potentially then run into penalties and all that good stuff that's thrown out there. Okay, so I don't know if we want to just take a quick break and see if there's any questions we want to catch up on, or if we want to keep moving on, Leon.
Yeah, let's do that. Raj asked another good question. I'm presuming he says, what happens if the owner changes as part of, I think he's saying charges as part of the S Corp. If the owner gets paid a salary as part of the S Corp, that counts in terms of payroll or not?
It would be his W-2 wages. It would not be any distributions taken from the taken from the S Corp.
Now, you and I were talking about partnerships. Guaranteed payments to a partner are compensation, right?
The rule was always self-employment. So I'm going to take the position that it's going to be line 1, or it's going to be, if you look at the K1 and you look all the way down at the bottom, there's 2 boxes, and one of them says net earnings from self-employment. That's the number I'm going to take for any of my partnerships, because that is because, you know, just because you call it guaranteed payments or you call it profit, you know, it doesn't make a difference. It's still subject to SE earnings. So, and that would be consistent with the treatment on a Schedule C.
Yep, and I agree with you on that. It's the SE income. In fact, that's how I answered it on our chat.
Yep. Jeff,
and Go
I
ahead.
see Jeff's, no, compensation does not include retained earnings. It's W-2, what's reported on the W-2 for an S corporation.
And we had another question from Claprice. On removing owner compensation for an S Corp, does it matter what their ownership is? If like an 18% owner, 18.5% owner, does it matter?
That's a great question. They just say an employee owner. So my argument's going to be probably anybody over at least the 2%, because that's typically the a lot of the rules that we use for tax purposes. As I would follow that, you may be able to argue a little bit higher of a percentage, but I think that they say employee owner, and so if you're an employee, you've got ownership, and you're receiving a paycheck, there's an argument that they should be thrown in there. So
you and I had a big discussion on the forgiveness form on line 9, because that's where they throw the owner's compensation in. And I was inferring from another CPA that that meant you couldn't add health insurance and you couldn't add other things in for owners. You pointed out that it doesn't say that directly. What's your position on owner? Let's say I make 100 grand, and so I'm taking the 15,385, but I also paid health insurance for myself. Can I put that back up on line 6?
Yes, I would, because I believe that because of the yes, I am going to take it that way, because that is still non-cash compensation, especially if it's an S corporation or a C corp. I would put it there. I would definitely, because you're still an employee. Where you wouldn't put it is if you're a Schedule C, because again, it's already been deducted as part of that calculation, if you will. So I would, going through the calculation, yes, I would still put it up there. I think there's an argument for that.
Okay.
A very strong argument.
I think it's important. That's a big one's going to come into play, because probably almost everybody on this call is an owner employee.
Yep.
Everybody is.
Yep.
So.
Yep. So I think that, there could be where you may run into, well, no, because I don't think it's going to be an issue. I was going to say, based on the W-2s, where you may have ran into an issue is because a lot of the S Corp is added to box 1, but I don't think that, since we're not doing W-2s, I would still take it on there. Again, I'm going to take the approach where I'm going to warn people or tell people, throw as much on there and as much as you can feel that you can defend. The banks are not going to act as the auditor, but they're going to do their due diligence to make sure it's there. And if there's something that's questionable, if you can make it a legitimate argument, I would try it, because if not, there's no other way to appeal this. Yeah. So, okay. And then I saw somebody in here says, I didn't have any W-2 earnings from last year. Now I am the director of this S Corp, no payroll. That's an awesome question. They've got to get around this rule, Raj, is because of the fact that you were technically employed, but where you may run into a problem is if that's the case, Raj, you didn't borrow on your own earnings then. So you're trying to get forgiveness on earnings that you didn't borrow on. So right. To some extent, it could make sense to me that you're not going to be able to get forgiveness on your W-2 earnings because you didn't necessarily borrow on them. So keep that in mind. Your borrowing was on 2019, where your payroll should have been. If you paid yourself in 19 or didn't pay yourself in 19, you didn't borrow on it. So now you're shorting somebody else, if you will. And so they're preventing, really what this is designed to do is prevent owners from manipulating the forgiveness so that they screw over their rank and file employees. And they don't want that to happen. Right. So, again, sometimes we
What if Raj had SE earnings out of this sub-S?
You can't. There's no way to get SE earnings out of a sub-S.
Yeah, it was only W-2. Yeah, you're right.
Yep. If he was a Schedule C and became a sub-S, then the Schedule C would still dictate. So I don't think there's going to be an argument. Right. Yeah. So I think you're right. Okay. So one of the things that they threw out there, and this has always been there since day one, is they said you're going to calculate all of your employees, and then we're going to reduce based upon you not hitting certain benchmarks to prevent you from not bringing employees back or bringing your paying employees. This would, remember, I can't stress this enough, this is called the Payroll Protection Plan, not the let's get my business back started plan. So this is all designed to pay employees. And I know that I think that this is the short-sightedness of Congress, is that they didn't anticipate it to be this long, and they expected it to be an 8-week process, and everybody would be back and running right now, and you know, everything would be fine. So, but knowing the spirit of when the intent was to pay payroll, they basically said, well, if you short payroll or you don't bring people back, we're going to penalize you, essentially, and not allow for it to be all forgiven. And so what they've said is that you cannot have more than a 25% drop compared to the average payroll in the first quarter compared to the average payroll in the covered or alternative covered period. Now, they clarified some things here, which was good, because the law stated that it was a quarter to the 8-week period, and so that was always an issue because you're comparing apples to oranges. And what they did is they said, we're going to allow you to take the average, annualize it, and then we're going to compare it. So there's a little bit of bringing apples to apples back versus apples and oranges, right? Yeah, okay. So what the other thing is, and we weren't sure on this, and they did clarify this, is average annual salary or hourly wages is the hourly rate. So as long as there's not more, as long as you're paying at least 75% of the same hourly wage that you paid them in the first quarter or their same annual salary as in the first quarter, then there's no wage reduction. Okay, the employees over $100,000 are not part of this calculation, or if they were not employed in 2019 are not part of this calculation. Owner employees are not included in this calculation. You only compare wages paid during the covered period or the alternative covered period. And after I thought, well, wait a minute, this seems like this is a bonus they're giving us, but in really what they've done is they've prevented a duplication or a double dipping of the quote unquote penalty. Okay, because if you think about it, for example, I've got an employee that I paid in the first quarter and I did not bring them back, all because of normal intent purposes. And so I didn't pay them I'm not paying them during the PPP period, the covered period. They're not used in this calculation. So whatever reduction I have in their wages is not counting against me in this calculation. Where they are going to hurt me is in the calculation of the full-time equivalents when we get to that calculation. So they're only allowing an employee not to be brought back to penalize you once, not to get you at the wage reduction and then to get you again at the full-time equivalent. And again, we'll get into the full-time equivalent on this, okay? There is the dollar for dollar, it's a dollar for dollar reduction. So if you calculate it out and it's $1,200, it's a $1,200 reduction of forgiveness. You have to do this calculation for every employee if you've got a decrease. Okay, so if you've got a decrease, you're going to have to go employee by employee. So if you have 100 employees, you have to do this calculation for 100 employees if you decrease their salary at any point in time. Okay, and it's a 3-step process that we have to do. And I'm not going to get into too much because I've got examples and we'll walk through those examples. Okay. Step 1, determine if the pay was reduced by more than 25%. That's a simple calculation. We look at our average pay.
Can you hear it now?
Okay. All right. So step 1, determine if you've got more than a 25% reduction. That's comparing the annual salary during the first quarter against the amount that was paid during the covered period. Step 2, determine if you've got if you've got a safe harbor. Remember what they said is if you lay people off between February 15th and 30 days after the law has been enacted, which is April 26th, and you restore back to full-time employment by June 30th, you've met the safe harbor, and that reduction in hourly wage or salary will not hurt you. They've defined that they're going to look at what is the comparison. They're going to look at did you bring back everybody by 6:30 compared to 2:15? So the 2:15 is the February 15th becomes a very, all of these dates are all applied throughout, and 2:15 is becoming a very special date in the PPP application for forgiveness. If you have not met the safe harbor, then you've got to go through and determine what your reduction is. So, and I've got some exciting examples here, and I'm going to try to go through them in a few minutes. We are going to provide you guys, everybody, with the PowerPoint, so you'll be able to look at these at your own as well. So we've got employee A. Employee A was making $18 an hour during the covered period. We dropped them down to 18 hours during the covered period. They were making 20 prior to in the first quarter. We only saw a 90% decrease. That they are above the 75%. We stop their calculation there and we move on. We don't have more than a 25% reduction. Okay. All 8 employees B, C, and D we'll see are all below that, where we go from 10 to 20, where we go from 20 to 10. It's backwards, but this is the way the instructions go. So I kind of did it so that it mimicked the instructions. We go from 20 to 10. It's a 50% decrease. We have to go to step 2 to see if the safe harbor applies. These are on hourly rates. Then we get into salaries, and what you do is you determine the average annual salary. So you look at during the covered period, you annualize their salary to determine what they made. So you would look and say if they're making $1,000 a week during the March 31st, or you take their first quarter multiplied by 4, that's their annual, and then you would take so let's say they're making $500 for a week during the covered period. You multiply that out by 52, that's going to get you out to $25,000. So that's how you're going to determine that average annual salary. It's determined at the period that they're asking you to look into.
Hey, Jamie,
yeah.
Someone just wanted to confirm. They're looking at the hourly rate per employee, not the total wages paid over the 8-week period
Yep.
per employee?
Yep. Originally, I thought it was you had to calculate it to into an actual wage. But if you go through that, it doesn't make sense relative to the step 3 of the calculation. So it has to be hourly rate, which is good because I don't know of an employer that decided to bring somebody back at a much lower rate. They would have brought everybody back at their normal rate. So I think that this is not going to hurt as many people as we thought it was going to hurt.
Well, that's the way the unemployment was. If you brought them back, at a lower rate, you're underemploying them, and they are getting more money on unemployment in most cases. Right.
So that's the calculation. That's first step. Step 1, determine if we've got a reduction. If we've got a reduction, we go to step 2. As you noticed, employee A, we don't need to do step 2, so I left them out of there. Okay. Then you've got so for the next one is determine if we've met the safe harbor. Now, the safe harbor basically says if you saw a reduction in the wages or employees during February 15th and 4/26, you are eligible for the safe harbor. If you did not have a reduction during that period, the safe harbor will not apply to you. So in example B, we started out paying them as of February 28th, they were making $20 an hour. After February 15th, we dropped them down to an average of $10 an hour. We saw a reduction during that time period. So they're part of that layoff period reduction. So we would get to move to the next step, which is looking at what did we restore their payroll to on June 30th. In this case here, employee B, we did not bring them back to that $20 an hour rate. So we failed the safe harbor, and we have to move on now to calculate how much of a reduction we have for this employee. Okay. Same for employee C, same scenario. We had, even though because we kept their pay the same at February 15th and during the layoff period, the safe harbor is not eligible because we did not have experience a decrease.
Jamie?
Okay. Yeah.
If you had a commissioned salesperson, how would that happen? You take the annual salary with commissions as of 2/15, and then and salary plus commissions during 2/15 and 4/26, right? Yeah,
and I think that you'd have to find a way to annualize that or anticipate what sometimes you have to go back through and look at what what have they done historically and looked at the same thing and try to annualize out what those commissions would look like.
Right. We have a lot of questions about the people coming back. You do not have to have the same people on payroll. You have to have the same FTEs, right?
So for this test, this is an employee by employee comparison. So right. Employee B is compared to employee B from the first quarter. At the FTE level, it doesn't matter. That's taken at the totality of all your employees. Okay. So the wage reduction is an employee by employee, and even in the application, you have to put the exception for employee by employee. And this is only for employees that were paid during the covered period. Right. And
so what if I left? What if I got rid of a manager? So I had a manager left, and I hired a new manager. They wouldn't be in this salary reduction
Nope.
calculation?
No, the only time that they would is if you where this gets interesting, okay, is if you brought on a manager and you fired them 2 weeks into your 8-week period. Okay, now you've got a comparison, and you could have a decrease here because you got rid of them during that covered period because you're comparing them to the first quarter. However, I worked through this and so you wouldn't possibly have a reduction for that person. However, you could argue that their annual salary was still the same. So for example, if you brought on a person and they only worked 2 weeks for you and they're making $10 an hour, that was their annual, that's their wage, and that we're making that same hourly rate, I would make an argument you don't have a reduction.
Right.
Because well, no, you know what? I'm sorry. There's an exception for this. Is if the employee was terminated for cause during the covered period, then they don't work for the exception.
But let's go back to Caroline's question. Caroline, I think Caroline's asking me and us, if she had a manager, the manager couldn't come back, she hired a new manager, that's not going to be in this salary hourly wage reduction example.
No.
And that manager, the new manager, is going to count for FTE, right, Jamie?
Yes.
Yeah.
Yep.
So
Yep.
for Caroline, for FTE purposes, you don't matter who it is. For the purposes of wage reduction, it does matter who it is.
Yes.
Right, Jamie?
Yep.
Okay, thanks.
Yep.
I just want to make sure, because this is so, yeah. By the way, guys, they simplified it for us. Isn't this how simplified it is?
Yep. So again, I want to kind of move a little bit quicker because I know I've got a few more slides, and then I want to make sure I give some time to Leon to give us a little bit of an update of what's going on. In this particular case, employees B and C fail the safe harbor because they didn't restore them back to the June 30th level. Employee D meets the safe harbor because we all of a sudden, even though we laid them off, but by June 30th, we brought them back onto the same $52,000 salary. They're now part of the exception now. They've met the safe harbor. Okay, so there's no subtraction for them. So then we get into the final step of how do we calculate. So employee B and C, we've now determined we have to reduce their wages. So there's two different calculations, if they're hourly or if they're salaried. And so you multiply the amount in 1B, which again, I'll go back to, the 1B is the average salary during the first quarter, okay? You multiply that by 75%, determine what should you have paid them, and then you subtract that out from what you did pay them to get the difference. So I should have paid this person 20, I paid him 15, I've got a $15 or a $5 an hour difference. This one here, I've got a $7,800 difference. That's my shortfall for the annualization, okay? Then what I have to do for hourly, I multiply by the number of hours, average hours of work they worked in the first quarter, and then so I come up with the weekly amount, and I multiply that by 8 weeks, and this is my reduction. So by not paying this employee their full $5 an hour, or $20 an hour, I have to reduce whatever I did pay them by $1,600. Go through the same thing with the salary though. They say take this $7,800 and come up with a 8-week average, and that comes out to $1,200. So what you have to do then is you have to reduce your employee, whatever compensation you calculate for these employees, you now have to reduce their wages by these dollars. Clear as mud, right? Good to go? Yes, we will be sharing the slides. Okay.
And we had an EIDL PPP question, but I'll answer that.
Okay. So full-time equivalent, this was kind of a little bit of what I would call the holy grail. We were all trying to figure out what are they going to determine for full-time equivalent, and a lot of us CPAs, we sat around our big tables and talked and said that we're going to say that it's 30 hours based upon the Obamacare Act. Well, in true Treasury form, they said, yeah, no, we're going to use 40 hours. So it becomes a 40-hour, it's based on 40 hours, and it's the average number of hours worked per week, and it's divided by 40. So it's you look at you calculate everybody's hours divided by 40 and determine, and you round it to the nearest tenth. So if they work out to if it works out to, something like a 0.93, you're going to round it down to a 0.9, okay? The cap obviously is nobody can exceed a 1, so it's got to be a cap. So again, for example, employee works 300 hours for 8-week period. 300 divided by 8 is 37.5. Divide that by 40, you've got a 93.75 or a 0.9 FTE. An employee works 400 hours for the 8-week period. 40 divided by 8 is 50. You max it out at 1. It's kind of self-explanatory. So you're going to look at this and this is going to be, even though you calculate the hours per employee, you're going to look at the FTE as a totality of the company, of all employees at once, not necessarily, unlike the subtraction that we just went through, that's at the employee level. This is at the company level. Now, what they did do is they threw a bone at us and said, you know what, we're going to make this simple. If you know you've got employees and they work 40 hours, just tell them they're a 1. Don't go through the calculations. And everybody else that works fewer than 40 hours, just give them a half employee and be done with it. This will probably work for a good portion of businesses. Where this may not work is if you've got just some minute differences, or you've got a lot of employees where that difference may be, or you've got a lot of employees that are working less than 20 hours, really is where it's going to come down to. Whatever method you choose, whether it's the actual or simplified, that's the method you have to use throughout all of the calculations for FTE calculations. So you can't mix and match, but that's what you've got to use. So I think that answers everybody was waiting for, what do we use for full time? It's 40 hours. We guessed at 30. We can't be perfect. We tried. Just can't do it. Okay.
And Jamie, if you had part-timers that made less than 20 hours, you'd use the secondary method to be a better way for you.
Right, but you've got to use that method across for every employee.
Yeah.
So you can't pick one employee and say that I'm going to use this method, and another employee I'm going to use this method. It's either I use the simplified for all my employees, or I use the actual method. So, and you may have to, I wouldn't encourage, part of what they've done, from what I can tell, is they've done this to help reduce the administrative process and the administrative burden to try to calculate some of this stuff. I don't know if they succeeded or not, but so, we're talking minor differences, I think. All right, so the loan forgiveness is reduced by they look at what your FTE is during the 8-week period, either whether the covered or the alternative, and they look at it to your reference period. The reference periods have not changed. They're the same as what we thought was in the law. February 15th to June 30th, or you can look at January to February. Your seasonal employers, you can pick any 12 consecutive weeks from May 1st to September 15th. So, and again, you have to use the same method for every employee. You can't pick and choose what makes sense for you. So you look at this as a totality and what's the best one for you. Okay. This is where there's an exception to the reduction in FTEs. This is where everybody's, well, what happens if I fire per whatever, blah, 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 all that good stuff, right? If you make a good faith written offer to rehire somebody and they reject it, and you document that rejection, you do not have to count them in the reduction. That's good news, because a lot of people are saying no because of unemployment. However, I caution you, if you've got an employee that rejects you, you might want to give them a friendly reminder that they are obligated to tell unemployment they were offered a job, and they will probably lose their unemployment benefits. Okay, so keep that in mind. They have also allowed you to exclude any employee during the covered period or the alternative payroll covered period for anybody that you fired for cause, voluntarily resigned, or voluntarily requested or received a reduction in their hours. Okay. And that's only available if that position was not filled by a new employee, because that makes sense, because the new employee would take up that person's FTE count. So they don't want you to stack the FTE count by some people saying this exception and then bringing on other employees. This is a one-for-one trade-off here. It does not reduce the loan forgiveness. The one thing I noticed, and we're going to show this in an example in a couple slides, is there's no exception that applies to any reductions that occurred outside of the covered period. For example, you decide to fire an employee on March 15th, and your covered period doesn't start till May 1st, that FTE count is going to count against you. And I'm going to show you that in an example. I had a client that it occurred to, and it's going to cost him dearly. So just to keep that in mind. Like the reduction in salary, there's FTE reduction safe harbor for the full time. Same dates. They're going to look at the FT levels between, if you laid people off between the 15th and the 26th, and that you restored them by to the same level as February 15th by June 30th, you're going to get the safe harbor. So it's the same concept. It's just applied at the FTE level versus at the reduction level. And yeah, this has all been clear. I'm sure everybody is just waiting to do this application. All right. So some examples that we put through here. These aren't the same employees as the previous one. They're totally different. So FTE for the reference period. Remember that reference period is either February 15th, 19 to June 30th, 19, or February. You get to pick whatever one is for you. So we had eight full-time equivalents in that reference period. We laid everybody off during the COVID time, and then but we had, prior to laying them all off, we had 8. Okay. We then, during the covered period, we only brought 5 back. Okay, during the covered period. But by June 30th, we brought the other 3 back. We meet the safe harbor, and so therefore we have a full-time equivalent of 1, or the quotient of 1. This is the number that we're going to multiply our forgiveness loan by to determine. So example, 1 times our forgiveness number. Let's say our forgiveness number is calculated at 50,000. 1 times 50,000, we get 50,000 of forgiveness. Okay. Example B, we had 8. We had 8 during the layoff period, which is February 15th to the 26th. We had 8. Obviously, we would have had 8 as of February 15th. But during the covered period, and I got this. This is wrong. I just noticed I've got an error in this sheet. So during the covered period, we had 6 covered employees, and then this really should be 6 too. I'll change this before I send the slides over. I just noticed that.
Right. Line 5, example B should be 6.
Should be 6. So that means that we did not restore back to. We needed to restore back to 8. We chose not to. So now only 75% of our loan is going to be forgiven. Of our payroll cost loan is going to be forgiven. Okay. So, and again, I'll change that. So I apologize for the confusion. This is the one that I have an employee. This is actual real time, and I just about cried when I saw this, but had a full-time, all of 2019 and early through February, they had 1 employee. They had 1 employee and the owner, and the owner's pulled out. So this is where the pulling the owner out kind of really, pissed me off, because it changes the calculation a bit. But they full-time equivalent, and then by the layoff, the terminated the employee, I think like around March 13th for cause. So they had 0 employees as of February 15, or through the layoff period. They have 1 employee as of February 15th. That employee still existed, right? But during the covered period and as of June 30th, they had 0. None of their loan is forgiven because they have a 0 quotient, because they have 0 employees. So the lower the employees, the bigger this becomes a problem for you, because there's such a difference in that number. Now, I've talked to the employer and said, I don't care if you have to hire a bum off the street and bring him to full-time employment by June 30th, because look what happens. You restore your full-time equivalent to the February 15 level, and now 100% of your loan is, or of the qualified loan is forgiven. So again, I don't care who, you be careful of who you hire. You don't want to hire your wife, because you never know if that's going to be questioned, right? But you need to pay attention to that June 30th, and if you should be, because it will have an adverse effect on your loan forgiveness.
Jamie, I'll hire your wife.
Yeah, there you go. We'll just start talking to your friends and start hiring each other's wives or something.
Hire everybody else. You can hire my son. I'll hire your son.
Exactly.
All right.
So, okay. So now what do we do? Now that we've learned all this, you're going to submit the application within, once you're done. Most banks I'm betting most banks are going to have this online, the application. The bank has 60 days to render you a decision. Again, don't rely on the bank to catch the mistakes. They've got to get out of jail free card. They're going to somebody said that there's been 2 million 2 million loans given out, And even if half of them go for forgiveness, the bank's got to process 1 million loans within 60 days. It's going to be a nut show. So, and then you have to provide documentation. And I'm not going to get into the documentation per se. This is exactly verbatim out of the instructions, but there's certain things that are going to be required. Bank accounts, a lot of third-party payrolls are already saying that we're going to provide you the report. Treasury said we'll accept that report instead of the bank statement, but you're going to have to prove that compensation was paid. You're going to need 941 state unemployment. You're going to need to give pay receipts, cancel checks, and account statements. So plan on getting some of this stuff now. Under the FTEs, you're going to have proof of how you calculated your FTEs between the various dates. So and again, if you're on a payroll, they're going to probably provide you a good portion of these. The documents must keep in mind that you may go past the covered period because again, that covered period, the payroll could go based on payroll after the first payroll after the covered period. Also, what's required for the non-business is going to be information on your mortgage. They're going to want to see that the loan existed prior to February. They're going to want to see what you've paid. So start talking to, if you've got a mortgage on a building, start talking to see what you get. Rent, they're probably going to want to see a copy of your lease. They're going to want to see proof of payment. You know, it's going to be funny for me because I pay mine online through their portal. Don't know if that's going to cover or not. So maybe I have to provide them my bank statements and highlight that this is the rent. Utilities, they're going to want copies of your utilities and proof of payment. So that's going to be canceled checks or account statements or whatever you may have. Start gathering this information now. Okay. What is not required, but you must maintain it, and all documentation, I've got this in red, all documentation must be maintained for 6 years from the date the loan is forgiven or from the repayment period. And SBA has the right at any point in time to come in and ask for any of this. So I'm telling my clients this is no different than an IRS audit. They may not, the chances of you getting audited are going to be slim to none, but you don't want to be that slim, okay? You don't want to be that one person that they get. So all of this stuff, there's a Schedule A worksheet. That's not going to be, that's where you list all the employees and you do some of the calculations. That's not going to be required, okay? But you should be maintaining that and keeping it somewhere. So worst case scenario, what happens if we don't repay it or we don't get it all forgiven? It's a 2-year loan with 1% interest. Interest is or payment is deferred for 6 months, non-recourse and no prepayment penalty. At the end of the day, this is not a bad deal. I think that everybody, it's going to be looking through this. I think you're going to have to be just about near perfect to get this thing forgiven. Meaning that the minute you got the loan, you started paying everybody and you just business as usual and you got everything and you have high rent and all of that, you're going to probably fall in that category. But if you played around with employees, deciding when to bring them back or waiting till you're open, you're going to have to plan on the fact that you're going to have to repay some of this. Okay, so we call this beyond PPP and beyond, right? So we wanted to kind of talk about what happens a little bit afterwards, and I want to give about 3 minutes to this, and then I want to give Leon the floor for the remaining 20 minutes to go through some economic updates and things of that nature. I think that at first, this Family First Coronavirus Response Act wasn't really going to be much of a deal because everybody was furloughed and all that. But now that we're slowly starting to see the state open up, and they're making selections on who can go back and who can't. And one of them that can't go back are daycare providers. So for example, I've got a dentist that is starting to go back, but he's got employees that have got small kids that they don't want to leave them at home. And now all of a sudden they've got an issue where they can request to have 80 hours of paid sick leave, and 10 weeks of it is paid by the extended family and 2 weeks is paid by the sick. You get a dollar for dollar credit on your 941, and it only applies for parents that do not have child care during the Michigan stay-at-home order. And there's also some limitations on you have to have special consideration for those children over the age of 14. So this becomes a very, very interesting dilemma. And the other side is that if you do pay and get credit on this, the wages that you pay on this are not eligible for forgiveness. So you can't double dip on this. So this, I think, is going to be for a lot of our employers. This is going to start to maybe become more and more of an issue because there's only a little narrow exception that if it's an undue hardship, that you can get yourself out of that extra 10 weeks. So keep in mind that you may have to revisit this act. And then there's also, you know, as we go through this, there's other areas that of the CARES Act that may start to apply payroll credits and delays. There's net operating loss, which is, you know, maybe a little bit more technical for a lot of people on this call. However, talk to your tax preparer, because if most businesses are going to start to see losses this year, probably, the thing should be is how do we plan to bring those back to maybe get money back from prior years? So they've loosened up the rules to allow for that to happen. And then there's some if you really get desperate, the CARES Act has also opened up some functionality relative to IRA distributions and 401k loans. And Leon, I'm going to throw that to you. I don't know, have you starting to see people to start to take advantage of these yet? The safe harbor, you know, relative to IRA distributions and things?
Yeah, you can take up to $100,000 out of a 401k plan or an IRA without an early distribution penalty, irrespective of your age. It's spread over 3 years. So you have 3 years of including your taxes. You can, if you pay it back, you can amend your return and get all the money back that you paid in taxes. So it's like a free 3-year rollover on a $100,000 distribution, Jamie.
Yep.
A lot of my clients I've been talking to are going to have a really bad year this year. So I'm looking at those as the opportunity. I'll take 100 grand out of I can take 100 grand out of their 401k and not pay any tax. So
right.
I'm using that one as a biggie. The loans, 401k, if you're a 5% or greater owner, you can't basically take a loan out of your 401k. If you're less than a 5% owner or just an employee, you can. That loan limit's from 50,000 now up to 100,000.
Right.
I actually like the distribution a little better.
Yeah, no. And Jeff asked a great question, and I didn't address this here. You know, if I had more time, I probably would. But are forgiven loans amount taxable as income? No. The Congress has clearly stated in the act that it is non-taxable income. The caveat with that is the IRS turned around and ruled and said, well, if it's non-taxable income, we're going to follow a certain revenue ruling that says any expenses associated with non-taxable income is non-deductible. So as of right now, the loan is not taxable, but the expenses that are forgiven are not going to be tax deductible. So this creates an indirect tax effect, because if you're like me, that business as usual for the most part, and I was paying these salaries all the way through no matter what, and now I've gotten it forgiven, those salaries go away as a deductibility, I have an indirectly increased my taxable income from what I planned on it to be. So there is
more money. You did get.
I got more money, right? So yeah. I'm not complaining about it, but just keep in mind that the forgiveness is not tax deductible, and you're going to need to talk to start your conversations early with your tax preparer on what this means relative to your tax plan. And I believe that, and this segues great into the next conversation, because I believe that there's talk in the new legislation that they may try to make this tax, the expenses tax deductible. But Leon, this is your specialty. Why don't you tell us where we stand on legislation and what this all means for us?
Great, thanks, Jamie. And I'm going to ask you to share in just a second. But
sure.
there is new legislation.
Gene, you've got that control.
So the basic idea is there's some new legislation actually floating around in the Small Business Association, the Small Business Senate subcommittee today. And if we saw what they're doing today, they're talking about potentially making the deductions still able to be done. And we're also talking about the potential of extending the 8-week period to take out times that businesses have been shut down by state order. And I've also seen a potential that it might go up to 12 weeks. That'll drive Jamie out of his mind and make him
don't mess with my PPP.
I don't know how they're going to go out doing that, but clearly what I'm hearing from DC, and I get involved with DC on a regular basis, unfortunately. What I'm hearing from DC is that there's a tremendous amount of money going to be pushed back out right now. So it's really an amazing thing. I'm going to throw a slide on. I just wanted to cover something kind of cool.
I'm going to stop sharing my screen. So
okay.
And Jean should be able to give you control, and there we go.
She did. And so,
All right.
just some perspective questions of the shape of the recovery. Are we looking at a V, a U, a W, or an L? Jamie, what I want to do is I want to go back to a time of 1917. 1917, we had the last big pandemic, the Spanish flu pandemic. By the way, for everybody on the call, I want you to remember a couple things. 2009, we had H1N. And I challenge all of you to tell me how many people had H1N in the world in 2009, and the answer is 1.2 billion. And I'm old, so I remember Woodstock. Actually, if you're actually at Woodstock, you don't remember it. But at Woodstock, during Woodstock, when just a few people weren't social distancing, there was a flu pandemic going on then. But 1917, more people were killed by the Spanish flu influenza epidemic than were killed in World War I. By the way, in 1917, when my dad was born, we were still in World War. We were in World War I and having a Spanish flu pandemic. In fact, 4 of my dad's cousins died in 1918. It's worthy of looking at this is that we had a recession coming out of World War I. And then right after the pandemic, we had a horrendous stock market crash and a horrendous depression. It was vigorous and down, and it was a V. And that was the depression in 1920, which nobody remembers. Coming out of that depression in 1920-21, the market went up. Actually, the stock market went up, the economy went up, everything went up through 1929. And then, of course, on October 29th, we had the Great Depression. Notice a W and a V. Then we had World War II, which is great because we were blowing a bunch of stuff up. So we were making a bunch of stuff, and at Willow Run, we were building bombers an hour. If you remember that, back again, and Dad was now in World War II. And we had a great recession of 1949. What I want us to look at is tax rates. You know, I'm a tax nerd, and Jamie knows that. In fact, Jamie and I, you can tell, the only 2 people maybe on earth who are all excited about looking at an 11-page loan application. I mean, it's just, there it is. So 1913, we got the income tax rate in, sat there at a nice little low rate, shot up in 1916, and then shot up to 64% in 1917, and then shot up to 75%. By the way, if you think your taxes are high now, how about 1945? Taxes were 94%. So first question I'm asking us is, what are we looking at in terms of debt to GDP? And in 1945, we were looking at 120% debt to GDP ratio. If I take us forward to today, guess where we're at? 125%. So here's what I'm worried about, guys. I'm worried about the fact that we just busted about a $3 trillion credit card bill, and all the taxes collected in the United States aren't $3 trillion. In other words, if I spent every single penny I collected, I'm not going to be able to pay for this bill right now. And now Congress, because they seem to have found an infinite amount of money to spend, wants to spend another $3 trillion. So first thing I want us all to remember is it's highly likely we're going to see some tax increases in the future. As Jamie will attest, the Tax Cuts and Jobs Act expires in 2025. But as I might point out, and I bet nobody knows this, there's a presidential election in November, and it's possible that something might change in Washington, and it's possible that we might see a tax increase even sooner than that. The good news is the market actually takes this through in stride. And I went back to 1870, which is about when I was born, and we run through all the different things that happened during this time frame, and you can see that 1920 dip and how ugly it was. Why do I think that's the case? Because I think the next quarter is going to be horrendous, and I think we're going to see a really, really terrible second quarter, followed by probably a pretty good third quarter. Here's a weird piece of evidence that we might have a V-shaped recovery. This really surprised me, because what I did is I ran stuff on a daily basis and to see if we had this retail apocalypse. If you look at like the top line, you can see what happened to airlines. And no surprise, you know, on May 1st, airlines were down 100%. And if we go out though, online electronics, which I happen to be using my new router, they're up 155%. Hey, if we can mute, somebody's online, so everybody can mute. Gene, if you want to hit
the person, I don't have access to mute them, Leon, because you have control right now.
Oh, sorry. All right.
Oh, that's
I
okay.
can't mute it. I think they heard it. Take a look at this though. This is the part that kind of is wild. April 26th, when we're getting toward the height of the pandemic, retail card spending was down 27%. By May 7th, it's only down 9%. So if I'm looking for a little bit of sunshine here, chart 1 shows me my daily total card spending based on the Bank of America card data. And you notice during the pandemic, oh man, it was ugly. It went down. And this is the gold bar is 2019. There it was, nice and steady. And the blue bar, look at that, 60%. But look where it is now. And look at chart 2, same thing. Huge surge, huge drop. Interesting. I just wanted to see chart 3, aggregated daily spending. No surprise, travel and entertainment spending is basically down almost 100%. No surprise, spillover sector's down substantially, down 50%. But to have a look, necessities up. By the way, necessities include Amazon and obviously toilet paper, and all else actually is getting right around to zero. And that's really interesting. One last thing I wanted you to hit on. I pulled up something I thought was really wild. This is the China real-time dashboard. And by the way, I'm not confident that everything I get from China is accurate. In fact, I'm pretty confident that everything I get from China is not accurate. But there were no COVID cases in China on 1/17 that we know of. And if we notice by February 7th, there were 21,000 COVID cases. No big surprise. By February 7th, China car sales were down 48%. By the 21st of February, car sales in China were down 91%. Electricity demand was going down. Electricity demand by March 6th was 67% down. I mean, so we see enormous changes in that. But have a look at what happened now as COVID seems to have declined. The Chinese economy bounced back hard. It bounced back significantly. So what I want us to think about is this. I actually am thinking that we're going to have the potential of a U-shaped recovery. But I also am thinking about the fact that the evidence is showing us that we may have a V-shape. Here's my biggest way of looking at this. I view that we have had a waterless tsunami. I think what happened is a tidal wave hit all 50 states and 132 countries, and it wiped out the economy, it wiped out the consumer environment, but it didn't wreck anything. Unlike a regular tsunami, it didn't hurt anything. So the biggest difference I see, and I'm a student of economics and I taught graduate school and I'm a nerd and I admit it, and I look at charts like this and try to figure out what the tax rate is every year since 1913. But here's the main point. In 2008 and 2009, we had a massive capital destruction. The mortgage market blew up. The amount of leverage, the 19 times leverage, blew things to bits. And it destroyed capital. It destroyed money. In this case, what happened is Congress and the Fed reacted. Now, whether they reacted great or not, Jamie and I could sit and argue the Treasury got this all wrong or whatever else, but I've never seen Congress act so fast and so uniform. And what they did is they said, oh my God, we lost $5 trillion out of our economy, and the Fed said, put it back. And here's the wild thing. If you make less than $52,000 a year right now, you're making more money on unemployment than you were making before. But guess what you're doing? You're spending it on toilet paper, and you're spending it on Amazon. But you're not going to restaurants, and you're not going out, and you're not buying new cars, and you probably will. So I'm going to put it on record as my idea is basically, I think that we're going to be able to have a V-shaped recovery. I think we're going to have a U, but I am highly, highly confident this will recover. So at that, Gene, I'm going to try to move the host back to you. I have to go how to do that.
While you're trying to do that, Leon, there's a question that, and I did not address this and it's a great question. DJ asked about, are hardware equipment leases considered to be eligible as overhead expenses? And I'm assuming, DJ, you mean relative to the forgiveness. At first, we thought it was going to just be real estate. However, they have put in the application that it applies to not only real property, but personal property. So I would make the argument that yes, it is going to qualify relative to any real property leases are going to be part of the forgiveness calculation, as long as they existed by February 15. So you can't use it to go out and get any new leases. But if you had a computer lease, or if you had any type of I think that it would. And I think that there's going to be some questions on whether it's a capital lease or not. But if it's a true operating lease, I think it would qualify. So
for whatever reason, I'm having a hard time trying to change it back to Gene, trying to change the host back to Gene. So they keep wanting to let me change it back to DeStigers for some other reason. So.
Okay. All we had is we'll provide the slides. We are pretty much done with all of this. If there's any, we can allow for any mute and any questions we have. In the rest of the slide deck just contains some more information relative to how to contact us, how to contact the Michigan Association of CPAs if you had any questions. The Michigan Association of CPAs has partnered with the Small Business Association of Michigan. And between the two groups, we formed website called the Michigan Paycheck Protection Program, in where you can submit programs or questions that go to a select group of CPAs within the MICPA to provide information for answers to that. So if you've got any questions, you can submit them there as well. And then if there's a couple times I think people ask where can I get a CPA if I need to, I would start at the association, or give Leon and I a call and we can try to set you up with somebody that may be in your area or can help them out with the PPP.
Gene, you're now the host. Jamie, you're a terrific nerd. I love working with you.
Same here, Leon. It was fun. So
it's always great to be with you. Gene, you're now the host. I did finally figure it out. I'm not going to make the Steigers host. You're now the host.
So
thank you both very much for your time. And we recorded this, so we will be happy to put the caveat on it that it was recorded as of today's date, bearing all the changes that are probably going to be coming through after this. But for everyone's knowledge, we'll be able to put this out on YouTube so you can listen to it and watch it again and share questions with Jamie and Leon if you have them moving forward. Thanks so much, both of you.
And we got it done within 5 minutes to go. How was that for timing?
Right? I knew you could talk faster. I knew it.
Good job, everybody. Thank you for listening. Gene, thanks for putting it together, and everybody have a great day.
Thanks, everyone.
Everybody stay safe.